Now, Minnesota is not exactly known as being an investment center. How did you come to work with APIS in Minnesota?
Well, I did spend 20 years in sort of New York, and I guess I'm from the Midwest originally, and born and raised in Minneapolis, and went to school at Wisconsin. And my first job out of school was on the East Coast in DC, actually in operations as a finance role at General Electric. But pretty quickly worked for GE and their pension fund, and that was based in New York and London. So I spent about 5 years in London. Maybe 5 years in sort of the New York area initially, and then back to New York after London for another 10 years or so before deciding, kind of from a lifestyle standpoint, some personal things in my own family, and my mother was ill, and some of the things which got me back to wanting to come back to Minneapolis. Plus, my kids were kind of at an age where about to go into high school, and it just sort of fit from a personal lifestyle choice to go back at that time. So, plus, what we do is very global. There isn't actually, New York isn't the center of the universe for small cap, stocks around the world. You can make the phone calls from Minneapolis. We have a good airport to get to Asia or Europe as is required. So yeah, you can do this job from just about anywhere. And in a way, we were well prepared because New York, we are still split between New York and Minneapolis as a firm, and we've been that way for the last 5 or 6 years. So, in terms of COVID and some of the changes in work, we were pretty well placed. We were already kind of doing video calls and things like this, and so it was a relatively smooth transition.
So you were Zooming before it was even a thing.
Yeah. It was Skype. We did Skype video, but Zoom and Teams is sort of where we live now, as everyone does, I guess.
Great. So tell us a bit about APIS, its beginning, and when you joined, and what you set out to do when you helped start the firm.
Yeah, it was kind of born out of our experience as mutual fund managers and sort of long-only managers. I had always had the ambition, I guess, to do something like that, to have my own investment firm. To be honest, I just never had the people, never had, maybe the self-confidence to just go off on my own and get a headhunter and hire a few analysts. I wanted to have, obviously good people, honest people, but people that, I believed were moneymakers and that, would do a good job. And so I had a lot of offers over my time at GE or at J&W Sullivan, which is where I had my second stint. But I think we just had a really good group of people, number one. There was also some factors at the time. The firm I worked for was very long into tech. They had grown and through the technology bubble of the 2000 period had kind of exploded. And then obviously we all know what happened. The tech bubble imploded. Now we were just sort of this little odd group in the corner doing international and global funds. I ran an emerging market fund as well as a global small cap fund. But the firm was having its issues, and so I don't want to say, there was no great opportunity cost, let's say, to leaving. But I said just as importantly was really just the opportunity to have really good people, and we thought a really kind of again born out of that long only experience. What we saw as sort of an opportunity to make what we thought was, kind of an idyllic product, a product that would really leverage and kind of have this flexibility to go wherever the research took us globally. We were, comfortable with investing. Actually, the one place we didn't have a lot of experience investing, ironically, was the United States. But that was easy. We'd always invested internationally, and what we kept finding all the time was that we learned something in one place that would help us understand something else somewhere else. But because of our mandate, we were restricted. If it was a small cap fund and you're doing work on a small cap company and you learn something that gives you an edge in a large cap company, well, you can't invest in that. You've got to stay in your box, stay in your lane, and invest in small cap stocks. Or just the same in emerging markets. You'd maybe find a company in India, and because of that, doing all your work surrounding that Indian company, you go, wow, I've just learned something about this U.S. company, and it's given me a real advantage in understanding that U.S. company that U.S. people don't see or appreciate because they're not looking at India. And yet, what can I do with that? I'm an emerging market investor. So, it was very frustrating at times. We'd say, oh, wait a minute, I have this huge, information advantage, which I've generated because I'm thinking about things globally. But because I'm boxed into this emerging market fund and only paid to invest in emerging market companies, I'm kind of stuck there. And I've got to just I could go to my colleagues across the hallway and say, hey, you guys, this is a really interesting opportunity for your U.S. funds. You should take a look at this, and here's why. But there was no way to express that ourselves. So for us, it was just this really, exciting opportunity to just go wherever the research takes you, go wherever you get the most leverage to your research. Who cares where the headquarters is? Let's just focus on these global situations where we can bring that global perspective and take advantage of that global perspective. So that was the kind of inspiration, I guess, for starting APIS.
Okay, so there's this global perspective sounds like it's a key part of your investment philosophy, being able to look across markets to see companies either in the same industry or in different parts of the value chain within an industry vertical, and use those insights. Are there any other key points to your investment philosophy that you think are worth highlighting?
I think the other ambition we had was to create, especially in hedge funds, was to have a product where we could put, our entire net worth invested into it and not really worry about market direction. I think, we had felt, and certainly in a long enough time frame, you could put your entire net worth in a long-only emerging market fund and probably do just fine. But would you generally want to do that? Maybe not. And so this opportunity to kind of create products that were generally low net, that our flagship fund is maybe runs 40 to 60% net, and maybe the deep value fund runs a little bit longer, maybe a little 50% type net or 60% net. But to have a structure where we could make money long, make money short, and have not be slaves necessarily to market direction or be terribly worried, and something that would stock picking, which is what we said we would be good at, drive most of what you get. Clearly, we're going to be impacted by market direction. There's no way around it. But to be able to kind of mute that somewhat and let stock picking really drive your returns was kind of the other, I guess, main ambition of launching these products. And we have, we eat our own cooking. We're invested, outside of my home or car. All my net worth is in our three products.
That's something that's important, and I hear that quite often when I talk to fund managers like you that have gone on to set up their own business after having worked for a larger firm, is that there's very much this focus on, all right, well, now I'm doing it, and I'm going to take everything that I've learned, the good and the bad from working in a larger firm, and I'm going to build something that I feel comfortable putting, having a lot of skin in the game, whether it be reputationally, but also investing your own assets into. And that seems to be a key driver across a lot of boutique fund managers that I talk to. It's I think it feeds into results too.
Yeah, I think the other thing you have to understand when you have a small investment firm is it's really just a small business too. And, there's a lot of aspects to, as I kind of developed myself, I was a GE, I had the luxury of just kind of being an analyst, being a portfolio manager, not having to worry about a lot of admin, although there's politics everywhere. And then you move into a more senior role at another company. And of course, you need to hire people and you need to do more marketing and put yourself out there. And so you develop those skills. And I think too, just kind of seeing GE, which had, strengths as a firm and an operation, and J&W Seligman, which had its own strengths and weaknesses as a firm, and you kind of learn, you see contrasting different businesses, and you kind of say, I can do this. It's all kind of about building that confidence in yourself that I can be a good investor, but I also won't be overwhelmed by the operational task, which is also pretty significant And what is at the bottom at the end of the day just a small business.
Mm-hmm. You mentioned very briefly in your answer that you have the two long short funds, one's deep value, and now a long only fund. Can you give us a brief summary of the similarities and differences between the three funds?
Yeah, absolutely. They're all very much related, and I sometimes regret. We sometimes regret the name Deep Value for the second fund, because it really is the small cap version of our flagship strategy. And our flagship strategy, again, from a U.S. person's perspective, is still a small cap strategy. The sweet spot there is probably a $1 to $5 billion type company. So it's many people consider that small cap, but that is a product that we could scale, that we thought could be a $1 billion type fund. But what we kept running into were things that were really small. It might be a $200 million company, and it's half owned by the family, and it trades by appointment, and but damn, it's cheap, and it's. But these aren't cigar butts. These are good businesses. These are compounding businesses. They have good growth prospects, but they're also extremely cheap. It was not uncommon to find things that were 2, 3, 4 times earnings. They were 15, 20% growers. And we really couldn't do that in the flagship strategy because of risk management, and because of we wanted to scale, and just the market cap and liquidity kind of kept us from those types of names. But gosh, you can't stop us. If you see something like that, you want to do the work. You got to get the family on the phone and try to understand this business. And so it was really just an outlet for us to be able to do those kinds of things and kind of take an owner's approach to investing, not be as worried about catalysts and getting paid near term, but just saying, look, this is going to be worth a lot more at some point in the future. And so we may get stuck in this name. We may be, like I say, have to act like owners rather than investors. But it was really just an outlet to be able to still have that fun and do those kinds of situations that we'd come across. And so that product does not scale. It's about $110 million product today, and we think it could be a $200 million product. But we'd close the fund. It just isn't. It isn't. Commercially, it's not a great product, but we still have fun, and it does give us a place to kind of scratch that itch when we see something that's really small. But in terms of valuation, in terms of the types of companies that we're looking for, that's really the same. It's just that typically, because they're so small and maybe so obscure, that they're even cheaper. But the growth characteristics are should be there as well. As far as the long only product, that's really just a carve out of what we're doing on the long side of the hedge funds. We have a really strong track record on the long side and a good track record on the short side. But we'd had people come just from a business, again, kind of business development standpoint. You get to talk to a different audience when you talk about long only. There's sort of there's a portion of the allocators who look for alternatives, and maybe 10% of their pie is in alternatives, and 30% of that is equity long short. You're down to like 3% of their pie, that you're fighting for. Whereas maybe half the pie is long equities. People tend to look at long equities, and it tends to be institutional type money. And so we have a great track record on the long side, and it's probably a shame we didn't start it sooner. But as of 2000, we started the long only, what we call the Global Discovery Fund, which focuses on a subset of the long ideas within the two strategies. The overlap is 95%. It's all the same names with a few exceptions, and we can get into that later. But really, we're trying, with some of the differences, there's a little room for speculation, I'll say, within the hedge funds. There's some names we do that, we're the same throughout the funds. We're looking for great businesses that can compound over many years. But there's a small part of the hedge funds where, let's say 5-10%, where we're, I consider speculation anything that doesn't make money, at least today. Obviously we think they're going to make money in the future. We're looking for companies that are really proven compounders, companies that are already generating, positive cash flow for shareholders, that are a little bit more mature for the long only product. We don't really, if one of those speculations works out and it starts to be a good long-term sound compounding business, then it can graduate. The other thing is we've tried to really not sell a great business in the long only product. There are businesses, I think one of our lessons learned, we call it don't cut your flowers in the bloom. It's, time and time again, one of our great weaknesses is selling a great business and watching it double, triple, whatever.
I'm going to ask you for an example now.
Oh yeah, there's too many to cite, but with the long only product, we're really trying. We may cut that position dramatically, but we really want to keep. If the business is working, if the market is still a good market, and the company is still executing within that market, kind of irrespective of valuation, we want to keep it on the sheet and just let it. You and I both know the secret to success is to just find a great business and never sell it. And if you can do that, which is really hard to do because you're getting bombarded all the time, and it's human nature to keep looking for that next thing. But the people who have that discipline, we want to have that discipline. I want to grow that discipline within myself, and I want that to be a part of the long only fund. To just kind of hang on to those great companies, almost no matter what. Although, like I say, we'll certainly reduce the position size if it's just on an extreme end of valuation.
Podcast is for informational purposes only. It does not constitute financial advice or take into account the particular investment objectives, financial situations, or needs of individual listeners. Listeners should consider whether any opinions or recommendations in this podcast are suitable for their particular circumstances and, if appropriate, seek professional advice, including tax advice.